And about the U.S. debt on negative watch, we will be interviewing Kun Gopsit Silapachai, the CFA Head Market and Economic Research Capital Markets Business Division of Kasikorn Bank, interviewed by Kun Thanong Kantong.
สวัสดีครับคุณกอบสิทธิ์ Welcome to our program. On Monday, Standard & Poor affirmed the rating for U.S. Treasuries, but it put the Treasuries on negative watch, and it has spooked the financial markets. So my question is, what's going to be the implications for the U.S. Treasuries and also the U.S. dollar in particular?
Well, I think it opens up a new round of uncertainty within the financial markets and the recovery that's been trying to take hold for the past couple of quarters already. Now, this uncertainty is coming to light because the different parties between the Republicans and the Democrats cannot find a middle ground in how to handle the growing deficits, the budget deficits going forward. So just to reference what S&P stated was that they noted that the size of the budget deficit of the U.S. is relatively large. The amount of debt is large as well. But the lack of clarity in how to deal with the level of debt in trying to balance the budget is not certain yet. And to make the point, to stress the point, was that Timothy Geithner noted that if things go as is right now, the U.S. government might run out of money basically by the middle of next month. So I think what S&P is trying to do is to flag that there is this risk if this impasse is not addressed, then the U.S. government can face the inevitable that it shuts down.
So is there any possibility of a U.S. government defaulting on its debt?
Well, there was a case in history back in, I think, if I'm not mistaken, in 1995. They played it to the last hour, but eventually it was in nobody's interest to try to force this as a political brownie point, if you will. So I think that the Republicans will have to find a middle ground along with the Democrats. But it's a close call. But if you look back in history, before September 2008, nobody would have thought that Lehman Brothers would have folded. So never say never.
So what's the implication for the U.S. dollar in this short term and also in the medium term?
Okay. Well, I think that the markets are probably going to take risk off the table. As we have seen, crude oil prices have come down by about $3 or $4 per barrel. Emerging markets or risky assets are under pressure for the time being. So people are piling into things which they think that metal money, gold if you will, is probably going to be in favor instead of paper money or fiat money. So in the short term, people are trying to reduce risk exposure just in case that the tensions are not cleared within the next couple of weeks.
And by June, the U.S. Federal Reserve will be completing its quantitative easing #2, and what's going to happen after that? Because some of the major bond funds, have stopped, buying U.S. Treasuries, and in fact, they have unloaded, all of the Treasuries from their portfolio. So, what do you think the Fed is going to do? Is it going to continue for QE3, or will it stop, by that point?
I think the Fed will have to probably take a pause for a while in terms of trying to add more money to the system. They've already added as much money as they can through the interest rate channel. So that's why they're supplementing, adding more money into the system by buying bonds or buying securities or mortgage-backed securities. Now, the thing is that it's such a big challenge that because unemployment rate right now, the unemployment rate is at 8.8%. It hasn't been.
Some
we haven't been
even higher.
Exactly. Because the participation rate is actually declining. People have given up hope to try to look for jobs because they've been trying for 2 years already and they couldn't find a job. So I totally agree with you that the 8.8 is probably an underestimation of the true rate of inflation. Some states, I think in California, is over 12% and so forth. So I think what the Fed will do is probably pause after June for a while. So
wait and see.
Wait and see, like a doctor has prescribed medicine. So has the patient responded favorably to the medicine or not before prescribing another round? If it looks like the economy cannot sustain its recovery by itself. I would imagine that the Fed will have to continue more of the same, which is to buy securities, try to keep interest rates as low as possible. So
How about, is there any inflation risk in the U.S. economy?
it's what the Fed would like to say is that there is no inflation, because they say that inflation excluding energy and food, it's still okay. But in reality, people have to drive and people have to eat breakfast. So there is an element of inflation risk.
But Americans, they are now paying almost like $4 a gallon.
Exactly. So
gasoline.
We're not even in the driving season yet, but gasoline has already taken up that such a high level. So there is inflation. So I think what the Fed has to do is to choose the lesser of the two evils. Do we live with higher inflation, and at the same time we try to moderate the high level of unemployment? I think the Fed is in that camp, rather than to say, okay, we're going to take money off the table, we're going to raise interest rates, and then the U.S. will probably go through another crash landing. And then we got to start all over again and cut interest rates and supplement more money into the system with QE2, QE3, QE4, and whatnot.
So there is more possibility of QE3 than higher interest rates.
I think if I look at the interest rates market, the earliest that the Fed will probably start to tighten or reduce the amount of stimulus is probably going to be in the beginning of next year. So I think this year there's a very remote possibility that they're going to start tightening this year.
Large holders of U.S. dollars are not happy of what's going on in the U.S. at the moment. Say like the Chinese central bank, all the sovereign wealth funds, who have been holding U.S. treasuries because of the quantitative easing program, which has, specifically or deliberately devalue the U.S. dollar. What are their options? What can they do?
Well, I think these the central banks, including our central banks, have to be probably more aggressive in trying to diversify out of fiat reserve currencies. By fiat, I mean not the car, but paper money. So I think when I look at some statistics, about 44% of reserves are being allocated through other types of other assets. It doesn't, not necessarily paper money. So I think people are looking towards more as gold. It seems like the reserve system is going back into time before we used to peg the dollars to the gold. So I think people are going back to commodity money rather than just holding on to paper money.
But the Thai Central Bank has been handcuffed by regulations. They can't diversify their international reserves.
Right. Well, I think then the issue then we have to try to work around this technicality. Either make the amendments so that we're not just a passive investor of U.S. Treasuries, and they dictate the terms of payment. They'll pay back us in U.S. dollars, but at a weaker exchange rate, of course. That means eventually we start losing money. We lose our savings that we have invested with the U.S. government. So I think to counter or be proactive, we have to work around the regulations, the technicalities, and start looking at other asset classes as viable investments in trying to get a better return on our reserves. So sovereign wealth fund is a great idea. I would say I understand that there are budgetary constraints because our fiscal position, we're not in a surplus yet, so that has to be dealt with. But I'm pretty sure if there's a will, there's a way to find a way to work around this constraint.
The Monetary Policy Committee is going to determine its interest rates today. What's your reading, or what's going to be the outcome?
Well, we're in the camp that they will proceed ahead with another 25 basis points hike in the policy rate. Because for three major reasons. I think the central bank has continually expressed its unease that real interest rates are still negative, and if it's not addressed, it will cause imbalances in terms of money chasing after property. There might be asset bubbles. The second point is, of course, that we have been using subsidies to actually mask the true level of inflation. For example, the producer price inflation, the inflation at the producer manufacturer level is about almost 5 to 6%. But the consumer is facing inflation of only 3%. And there is going to be a limit to how much we can continue to subsidize. So inflation will come through. And the third point is, of course, there is another way to combat inflation by allowing the currency to appreciate. But the issue is that our neighbor to the north is using interest rates rather than allowing the yuan to appreciate. So if we appreciate our currency to the dollar, we lose competitiveness towards China. So we have to go through that route.
Thank you very much for joining our program.
My pleasure. Thank you.